Okay, pause. If you checked silver this morning, you probably thought your chart glitched because around 11 a.m., silver didn't dip. It dropped like someone yanked the floor out from under it, and it did it fast. And the wild part, gold moved too. Not as dramatic, but enough to tell you this wasn't just one random trade in one corner of the market. Now, here's the question that matters. Was that a real move or a manufactured moment? It's Friday, February 13th, New York time. Comment what day and date you're watching from. Quick thing before we break this down. I'm running a campaign to eliminate copycat channels. If my work helps you, support it by subscribing and commenting our John AG. All right, let's talk about what just happened without the panic, without the noise, and without pretending we know the one perfect answer 5 minutes after the fact. Because that drop didn't just hit price, it hit psychology, it hit leverage, and it tested everyone who calls themselves long-term when things are calm. So picture the scene. Late morning, the market is doing what it usually does. Little pushes, little pulls, the normal tug-off war. Then silver just snaps. In roughly the time it takes to make coffee, it's down around 7%, give or take. Gold follows with a move that's smaller, more like around 3%, but still sharp for that metal in that short of a window. And if you're holding paper exposure, futures, leveraged ETFs, options, that kind of move is not interesting. It's a margin call waiting to happen. But if you're holding physical metal, that move is a different kind of event because your bars and coins don't evaporate in 30 minutes. The screen moves, your stack stays. And that difference is the whole story. Now, I know exactly what some people heard in their head the second they saw the red candles. Manipulation. And look, there's a long history of weird stuff in precious metals. There are players with deep pockets. There are incentives. There's leverage stacked on leverage. And there's a lot of trading volume that never touches a single ounce of real metal. So I'm not here to pretend markets are some pure, perfectly fair classroom experiment. But I also don't want to hand you a lazy explanation that feels good and explains nothing. Because sometimes the most sinister-looking move is just mechanics. And today had a lot of mechanics written all over it. Here's one way this kind of thing can start. Not with some villain twirling a mustache, but with a thin patch of liquidity. Maybe it's a quiet moment on the order book. Maybe a big seller shows up and hits bids harder than the market can absorb. Maybe an options dealer is hedging a position as volatility spikes. Maybe a large fund is forced to reduce risk across multiple assets at once. Any one of those can start a chain reaction. And in silver, chain reactions happen faster than people expect because it's a smaller, more volatile market than gold. Silver doesn't need a giant shove to fall down a staircase. It just needs the right shove at the wrong moment. And once the first leg breaks, stops trigger. Then more selling, then more stops. And now you're not watching a price discovery process. You're watching a forced unwind. That's the part most people miss. They think a big red candle means everyone suddenly believes silver is worth less. No. A big red candle can mean the market structure got stressed and weak hands got shaken loose. That's why these moves feel like an ambush. They're not about belief. They're about plumbing. Let me show you how the plumbing part can get ugly. Because once you understand this, days like today stop feeling mysterious. Most people think there's one silver market. There isn't. There's the physical world. Metal that has to be mined, refined, shipped, insured, stored, and there's the traded world, contracts, swaps, hedges, baskets, and promises that can change hands 1,000 times without a single truck moving. The traded world is where the speed lives. And the traded world is where these late morning air pockets show up. Here's the typical setup. Volatility gets quiet for a while. Price grinds up. Everyone gets comfortable. Then leverage creeps in, because leverage always creeps in when people feel safe. A trader borrows a little, a fund adds exposure, a dealer sells options because volatility looks cheap, and none of that feels dangerous until the moment it does. Then one fast drop pushes the market into a zone where risk models start blinking. That's when you see the non-human selling, not emotion, rules. If you've ever had a broker email you and say, "We need more margin," you know what that feels like. You don't get to debate it. You either add cash, cut the position, or the position gets cut for you. Now, scale that across thousands of accounts, and you get a cascade. And once the cascade starts, something else happens that people underestimate. The bid side steps away. Not because buyers hate silver, because buyers don't want to catch a falling knife when the knife is being thrown by an algorithm. So liquidity dries up, spreads widen, and the same amount of selling pushes price farther than it normally would. That's why the candle looks insane. It's not always more selling. Sometimes it's less buying. And that distinction matters because less buying can reverse quickly once the panic subsides. Now, another fresh piece of context that's been showing up in recent market updates is how tightly everything is connected to rates. When real yields move up, metals often feel it because metals don't pay you interest. So traders compare holding metal to holding something that does pay you. That's not a moral judgment. It's a portfolio math problem. And when the market suddenly decides rates are going to stay higher for longer, you can get a wave of selling in anything that benefited from the opposite belief. Metals, growth stocks, crypto, even some real estate plays. It's all part of the same breath. Inhale risk, exhale risk. And today look like an exhale. But here's where silver is different. Silver isn't just an inflation trade. It's also a manufacturing trade. And that's why the long-term argument doesn't disappear just because yields wiggle around for a few weeks. Based on recently published numbers on power generation and electronics output, the industrial side of the story is still real. And that's why the screen can drop while the physical world keeps taking metal off the shelf. Now, if you want a historical parallel, silver has done this before. You've seen it in moments where margin requirements were tightened. You've seen it in moments where an overhype rally got too crowded and then snapped. You've seen it when a global shock hit and investors sold whatever they could to raise dollars. The pattern is not new. What's new is the speed. And the speed is why you have to plan for turbulence ahead of time, not after the fact. Because after the fact, your brain wants a story, and it will grab the first story that makes the pain feel justified. Sometimes that story is correct. Sometimes it's just comfort food, and comfort food can make you overweight in bad ideas. So keep your mind open, keep your sizing sane, and keep your strategy simple. Now, there was also something else floating around earlier in the morning, an attention-grabbing political headline. The gist was some internal memo out of Russia was allegedly pitching a kind of reset that would lean back toward a dollar-centered system with the next White House team in mind. You've got rates that keep refusing to behave the way easy money traders want them to behave. You've got debt and deficits hanging over everything, like a low ceiling. You've got a stock market that's been acting confident on the surface, but jumpy underneath. And you've got a dollar that can go from weak to strong in a hurry when risk sentiment flips. That mix creates sudden, violent moves in anything that's heavily traded and heavily levered. Metals are not immune. So when today's drop hit, it likely found people already positioned, already stretched, already watching the same levels. And that's when a clean chart becomes a trap, because charts attract crowds, and crowds create vulnerability. Now, I want you to notice something important about how gold behaved versus silver. Gold moved, but it didn't fall apart the same way. That's a clue. Gold is deeper, more liquid, and often treated as a macro hedge by bigger institutions. Silver, in contrast, gets treated like a hybrid, part hedge, part industrial, part speculative. So when forced selling happens, silver can get hit harder, and it can overshoot. That overshoot is where opportunity often lives, but you have to be careful with that word opportunity, because what looks like an opportunity can become a trap if you don't respect the possibility of another leg down. So let's talk practical. If you own physical silver and you bought it for the long run, a move like this should not automatically change your plan. It might bother you emotionally. It might be annoying, but unless your thesis with silver never goes down in the late morning, your thesis is still alive. In fact, volatility is part of the thesis. Silver's story has always been higher upside with higher turbulence. You don't buy a speedboat and then get mad that it bounces on waves. But if you're holding paper exposure, today is the day you learn what you actually own. A futures contract is not a coin. A leveraged ETF is not a bar. An options position is not a stack. Those instruments can be useful, but they come with a clock and a trigger. And when the market moves fast, the clock speeds up. That's why I've always said, know the tool you're using. Don't confuse the wrapper for the thing. Now, I can already hear the question. So, what do we do right now? First, breathe. Second, zoom out. Silver has a habit of doing these violent intraday moves and then later looking back like it was nothing but a spike on the chart. It's the financial version of a jump scare. But that doesn't mean you ignore it. It means you respect it. If you're a buyer of physical silver, you think in tanches. You don't try to nail the bottom. You don't dump your whole budget into one candle and then pray. You scale, because scaling is how you turn volatility from a threat into a tool. Also, watch premiums. When screen price falls quickly, physical premiums don't always follow in real time. Sometimes they widen. Sometimes dealers get cautious. Sometimes inventory gets sticky. So, your deal on paper isn't always a deal at checkout. And that's not a conspiracy. That's just real-world friction. One more angle that matters, especially if you're holding physical, is the difference between price and access. When paper price drops, your instinct is great, I'll just buy more. But the real world has its own rhythm. Dealers hedge, inventories move, and sometimes the cheapest screen price is the moment physical gets hardest to find at a fair premium. So if you're planning to add, think like a shopper, not like a day trader. Compare spreads, check delivery times, be patient. And don't ignore basics like security and authenticity. When volatility hits, scams show up. That's just reality. Now, if you're sitting there wondering, should I switch to gold instead? Remember, gold and silver play different roles. Gold is the anchor. Silver is the accelerator. Gold tends to be steadier. Silver tends to be wilder. In some cycles, silver outruns gold. In others, silver lags and then suddenly catches up when sentiment flips. That's why some long-term holders treat silver as a way to add torque to a precious metals allocation, not as the whole engine. And if you follow the publicly available positioning reports, you'll notice something else. When speculative interest gets crowded, reversals can be violent. That doesn't mean the thesis is dead. It means the trade got crowded. And crowded trades always pay a toll at some point. Sometimes the toll is time. Sometimes the toll is pain. Today was pain. But pain doesn't tell you the destination. It just tells you the road has potholes. So instead of asking, who did this? Start asking, what does this clear out? Because if this move flushed leverage, broke weak hands, and reset sentiment, the next rally, if it comes, can be cleaner. And that's the part to watch. Now let's get back to the why, because this is where people get stuck. They want one villain, one headline, one switch that got flipped. But markets are usually a pile-up, not a single car crash. So here's a more complete picture. You have the macro backdrop, debt, rates, currency swings, election uncertainty, geopolitical noise. You have the positioning backdrop, traders leaning long, V compressed, confidence high. You have the structural backdrop, heavy use of derivatives, thin liquidity pockets, stop clusters. You have the narrative backdrop, a spicy headline about global currency politics. And you have the mechanical trigger, a burst of selling that cascades into forced selling. Put that together, and you get exactly what we saw. A sudden, ugly drop that looks impossible until you remember how these markets are built. Now, let me challenge one popular assumption. A lot of people assume the only reason metals get slammed is because they're trying to keep people away from real money. And I get why that story is attractive. It turns a confusing chart into a clear moral tale. But it also can blind you, because sometimes the market slams metals for the same reason it slams everything else. People are de-risking, they're raising cash, they're meeting margin, they're rotating, they're reacting to rates. In other words, it can be less about anti-metal and more about pro-S survival. In a fast sell-off, traders sell what they can, not what they want. And liquid markets get hit first because they're easiest to hit. Silver is liquid enough to be sold quickly and volatile enough to move dramatically. That makes it a perfect pressure valve. So yes, there are times when metals markets look managed, but there are also times when they're simply being used as a funding source. And if you want to actually navigate this, you need to hold both possibilities in your head. Now, let's zoom even further out, because this is where long-term holders gain an edge. Silver has always been a narrative tug-of-war between scarcity and abundance. On one hand, it's mined, it's produced, it's used up in industrial applications, and a lot of it is not economically recoverable once it's dispersed. On the other hand, it's treated like a financial asset, where paper contracts can represent massive amounts of metal that never move. That disconnect creates these weird moments where price can swing wildly without anything changing in the physical world. And it creates a gap between what the screen says and what the supply chain feels. That's why you sometimes see the screen price drop while physical demand stays strong. Or the opposite, price spikes while premiums calm down. The two markets talk to each other, but they're not the same language. Now, one of the biggest fresh context pieces people keep underestimating is industrial demand growth. Silver isn't just sitting in vaults, it's getting baked into technologies that scale. Solar is a big one. Electronics are a big one. And as more infrastructure gets built, power grids, data centers, devices, silver demand has a real-world floor. At the same time, mining is not a magic faucet you can turn on overnight. New supply takes time, projects take years, permits take time, capital cycles are slow. So you end up with this long-term squeeze potential. Demand can rise faster than supply can respond, especially in certain periods. And when that happens, silver can move in a way that shocks people who only look at it as the cheap cousin of gold. Now add another layer: investor psychology. Silver is notorious for causing people to overtrade. It's exciting, it moves, it gives you dopamine, but it also punishes impatience. The people who win in silver over time are usually not the people who chase every candle. They're the people who build positions methodically, survive the storms, and let time do the heavy lifting. If you're successful, share your success story in the comments so others can stay motivated. Now, I want to talk about the support level idea without turning this into a textbook, because there is something to it. Markets remember. They remember areas where buyers showed up before. They remember zones where price broke out, where it paused, where it fought. And when price comes flying down, those zones can act like a net. Not always. Sometimes the net tears, but often the first place buyers step in is around prior battlefields. That's why, after a drop like today, you want to watch what happens next, not just what happened. Does price stabilize? Do we see a bounce that holds? Do we see volume calm down? Do we see sellers run out of urgency? Or do we see another wave that says, the unwind isn't done? Because here's the cliffhanger. The first drop is often not the last move. Sometimes it's the opening act. Now, what about that idea that banks covered shorts at the bottom? Could that be part of the story? Sure. In any market with big players, you can have participants who profit from volatility and can use volatility to shift positioning. If you're short and you can push price down into stop territory, you can create a cascade that helps you exit. But be careful with certainty, because you and I don't get to see every motive in real time. What we can see is outcome. And the outcome today looks like a washout, a flush. The kind of move that clears the table. And clears the table for what? That's the real question. Because once the leverage gets shaken out, the market can do one of two things. It can drift lower as confidence stays broken, or it can snap back hard because the forced sellers are gone. And silver is famous for snapbacks. That's why these moments are so emotionally dangerous. People sell at the worst time because they can't handle the feeling. Then the rebound happens and they feel stupid. Then they chase again at a higher price and the cycle continues. So, if you want a simple rule, don't let a 30-minute move rewrite a multi-year plan. But also, don't ignore risk if you're using leverage tools. Now, let's talk about gold for a second because gold's move matters. Gold is the anchor. When gold gets hit alongside silver, it tells you the move is macro-flavored, not just industrial. It suggests something like dollar strength, rate sensitivity, broader risk-off sentiment, or a big fund doing a cross-asset adjustment. And in the last couple of years, we've seen more of that cross-asset behavior. Money moves faster now. Algorithms react faster now. Risk models update faster now. So normal volatility in a chart from a decade ago can look tame compared to today. That's another piece of fresh context. The trading ecosystem has changed, even if the metal itself hasn't. Now, what could have happened specifically in that late morning window? Here are a few plausible triggers that don't require a conspiracy. 1. An economic data surprise earlier in the day set the tone, pushing yields up and pressuring metals. 2. The dollar caught a bid as risk sentiment shifted, and metals got sold as part of that move. 3. A big options-related level got tagged, forcing dealers to hedge in a way that accelerated downside. 4. A fund hit a risk limit and had to reduce exposure quickly, selling what was liquid. 5. A cluster of stop orders sat just below a key zone, and once it broke, the machine took over. Any of those can be real, and more than one can be true at the same time. Now, where does that leave the person who's not trading ticks but building wealth? It leaves you with a decision. Are you reacting or are you allocating? Reacting is emotional. Allocating is deliberate. Allocating is saying, I'm buying a little here, and if it falls more, I can buy a little more. Allocating is using volatility to improve your average cost. Allocating is keeping cash in reserve so you're not forced to make decisions under stress. That's the game. Now, I also want to address the uncomfortable truth. Not everyone should buy this dip. And that's okay. If your bills are tight, if your cash buffer is thin, if you're already overexposed, the best move might be to do nothing because the worst thing you can do is buy metal with money you'll need next month. Silver is not a savings account, it's an asset with mood swings. So be honest with your situation. Now, if you're more advanced and you're thinking about paper hedges, that can be useful too. Some people like to hedge physical with paper. Some people like to trade around a core position. That's fine. Just remember, paper can go to zero faster than physical can disappoint you. So size it accordingly. Now, there's another layer we haven't talked about yet, and it's important, the bigger economic story. Because when people say they're bullish on silver long-term, they're usually not saying it because they think tomorrow's candle will be green. They're saying it because the world's financial math is getting harder. Debt keeps compounding. Deficits keep piling up, and the political system keeps finding reasons to spend first and argue later. That doesn't mean hyperinflation is guaranteed. It doesn't mean the dollar is finished tomorrow, but it does mean the long-run environment is unstable. And metals historically do better in unstable monetary environments than people expect. Now, here's the twist. Metals can still get crushed in the short run, even in a long-run bullish setup. We saw that in different eras. We saw it when liquidity mattered more than thesis. In a panic, everything becomes a source of cash, even the things people believe in. So today's drop doesn't invalidate the long-term case. It just reminds you that the path is not smooth. Now, let's bring it back to the Russian memo headline for a second. If that story has any real significance, it's not in the immediate price move. It's in what it reveals about the world. The fact that people even talk about a reset back toward the dollar system tells you the currency conversation is loud. The fact that markets even react to that kind of idea tells you narrative is fragile, and fragile narratives create volatility. But I don't want you to anchor your investment plan to a rumor about a memo. That's how people get whipsawed. If you want to use geopolitical context, use it as background, not as a trigger. Now, so what's next? There are two timelines. The short timeline is the next few sessions. Does silver reclaim the ground it lost, or does it chop and frustrate? Does it bounce and then fade? Does it consolidate? Does volatility shrink? The longer timeline is months and years. Does silver continue to ride the industrial build-out story and the monetary instability story? Does it remain a hedge people return to when confidence breaks? And here's the cliffhanger that nobody wants to admit. Both timelines can be true at once. Silver can be messy short-term and powerful long-term. That's the deal. Now, I want to leave you with a framework you can use the next time this happens, because it will happen again. When you see a violent move, ask 3 questions. What changed in the real world? What changed in positioning? What changed in market structure? Most of the time, the real world didn't change in 30 minutes. The mines didn't shut down. Solar factories didn't stop. The laws of physics didn't update. But positioning and structure can change fast. Leverage can unwind fast. Liquidity can vanish fast. And that's why the chart can look like a cliff. So don't confuse the chart with the world. Use the chart to decide execution, not conviction. Now, if you're holding physical silver, this is the moment to remind yourself why you bought it. Was it for a quick flip, or was it for long-term protection and optionality? If it was for long-term, then today is noise with a lesson. If it was for a quick flip, then today is a reminder that quick flips can flip you. Now, last point. If you're new and this move scared you, that's normal. Silver is not gentle, but fear is information. It tells you your sizing might be too big or your expectations might be too tight. Use that. Adjust. Because the goal isn't to be right on every candle. The goal is to stay in the game. And if you can stay in the game, you can let the long-term forces work. Volatility is the price of admission. All right, watch the next move, because what happens after the flush is what tells you whether this was a shakeout or the start of something bigger. And one more thing before you go. Everything we covered here is for education and perspective, not personal financial advice. Your money situation is unique, so think it through. Do your own homework.